Hello and welcome to this week's edition of Inside Today's Boardrooms from Diligent Institute, your source for the latest in corporate governance best practices, all in 10 minutes. My name is Lisa Edwards and I'm your host for today's show. I'm joined by Mark Baudler, partner at Wilson Sonsini Goodrich Rosati. Mark, how are you today?
I am doing great. Delighted to be here and looking forward to our conversation.
Wonderful. So today we're talking about something that is on a lot of people's minds, which is the capital markets and IPOs. And I know as a premier advisor to companies that are looking to go public, you really have an eagle eye on the view of the landscape. So maybe just start by telling us a little bit about what's going on in this current environment.
Well, first of all, I will make the comment that I am delighted that we are talking about the capital markets in the United States. It's been quite some time since this has been a viable option for a number of companies. A number of companies, have weathered the storm of the last couple of years quite well. Some obviously better than others, but it really wasn't a possibility to take a company public for the last 18 to 24 months. And so it's terrific to be talking about this again, which is not to say that we're in a place where the receptivity to IPOs is what it was in 2021 or the few years that preceded it, but at least we're having the conversation. I think many people know that there's been a few recent technology company IPOs with ARM and Instacart and Klaviyo. And I think that there will be more to come. We're certainly in conversations with a number of companies that are thinking about a 2024 IPO, some as early as the first quarter of next year. Now, all of that needs to be taken with a grain of salt. There's a tremendous amount of activity kind of in the macroeconomic environment that continues. We obviously have what's going on in Israel that could disrupt markets, and so I'm awfully cautious about predicting what's going to happen in the future. But as of now, it's terrific to be talking about U.S. IPOs at this point in time.
Yeah, I know there was a lot of pressure on those IPOs that were going out earlier. A lot of people were looking at them as a bellwether of sorts. And how did they hold up in the markets as they went out?
They held up well compared to what their initial filings were, and I think that the banks in those cases did a good job of kind of setting the expectations and then having the investors be able to beat those expectations in terms of the pricing at least. Now, there's a couple of aspects of this that I think bear paying attention to. One is, especially for companies like Instacart that had done large private rounds of financing, I think that there's a reality to the valuations that you're seeing now compared to what those high private company financing valuations were a couple of years ago. And that just reflects the deterioration in the markets over those couple of years. And I think it's good to have that grounding. One of the things that I advise companies when they're doing IPOs in particular is, for the most part, there's a capital raising component to it, but you're selling, a minority stake in these companies. So 10%, give or take some. And so this is a long-term, strategic transaction for the company. Not, it's not the same thing as selling the company and being focused solely on valuation. And obviously going public gives companies, access to the U.S. capital markets, visibility, things that, are a little bit harder to come by as private companies. And so I always advise companies to go public for the right reasons, which we're really seeing companies, think about and deliberate on. Now, in 2021, we saw a lot of companies look at it as an opportunistic transaction. Money was flowing rather freely at that time, and there's a number of companies that went public that may look back on that and be happy that they put money on their balance sheet, but they've had some struggles, kind of growing up, if you will, as a public company. So I think that for the most part, the companies that are thinking about going public now, or at least talking about it, are well positioned to do that. They're a little bit more mature. There's been a lot of discipline that has been imposed on these companies over the last couple of years, a real focus on profitability and paths to profitability. There's still a focus on revenue growth as well. And I think that, having those things in mind when you're talking about going public is good. One of the other things that we're seeing, and we've seen this before, but maybe to a greater extent with some of these recent deals, is having kind of an anchor investor in the IPO itself. So it can be a large commercial partner or somebody like that that's really vouching for the company. I think has been something that we have seen and will continue to see with companies who have such a partner, and it can be kind of that anchor to a public offering. So those are some of the trends that we're seeing as well.
Yeah, that's great. And I think since it's been a minute since the IPO market was really hot, maybe let's talk about just what are some of the things that companies should think about that maybe they're not thinking about right now if they're thinking about going public next year, in the near future, and add on to that, maybe how is that different from the guidance that you would have given them pre-pandemic or even 2 years ago?
My thought about this is that in my experience, the bar always gets raised over time in terms of the companies that can really have viable IPOs. The annual revenue rate goes up over time. The expected maturity of those companies go up over time. The visibility into profitability goes up over time. How those companies kind of function as private companies, the bar continues to get raised. And so if that's something that a company is thinking about, in the next, let's say 12 to 24 months, I really don't think that you can start too early in thinking about, some of the things to get ready to be a public company. And they're less blocking and tackling from a legal perspective and more either governance related or, kind of operational. You want to make sure that your commercial engine is really working well, that, one of the hardest things for a private company is to have visibility into, future operating results. And when you go out, there is an expectation that you're going to, meet and beat the guidance that is out there. And that starts, with the guidance that you're giving the analysts for the syndicate banks as part of the IPO process. And there's a lot of time spent in, getting good at that. There's also a lot of time that needs to be spent in having the right accounting and financing, staffing and support. And that's not all internal. I'm not asking companies to rev up their internal G&A spending a lot, but what I would ask them to do is make sure that they have enough resources. And some of them can be external. There's, a number of great external consulting firms that can help companies get ready, that can talk about internal controls and those type of matters, and really get a company well positioned to make that transition from being a private company to a public company in the future. Likewise, I think companies really need to spend some time thinking about, some of the governance issues. I think, board composition looks very different for a public company than it does a private company, and beginning to think about, what are the right types of board members. And I'm not talking about solely, requirements like having an audit committee chair and a financial expert and maybe somebody with some cybersecurity experience and other things that you might see. I'm talking about, who can be additive from a public company operational and strategic perspective. Oftentimes, private company investors may remain on the board for a short period of time, but usually not a longer period of time. And you want to find the right people. You don't want to be finding board members just to check the box. These people are part of your team. They're part of the fabric of the team going forward. And it takes some time to find those right folks. And so I think companies can be very well served to think long time in advance before they want to go public about filling out that public company, board capabilities and, what attributes and what experience and what industries can really be additive to the mix on the board. And there's other issues to think about too. We see a number of companies go out with dual class stock structures and thinking about is that right for a company or is it not right for a company? That can be the subject of pretty significant deliberations by a company and its board as a company thinks about going public. So thinking about those longer lead time items early in advance, and this is less kind of churning on preparation matters such as getting a diligence room done. I think that can be done later. It's less in writing, a draft of your S1, although some thought can be given to positioning. And it's more of these longer lead time items to how a company will function as a public company and making sure it's ready to be a public company, frankly.
Yeah, it's great advice, and I think certainly the economics have changed a little bit in terms of growth versus profitability. But your point is well taken. I can't tell you how many calls that we get at Diligent from people who say like, "Okay, I'm ready to go public. I need you to find me board members. I need a board portal. Like, do you have any of this ESG stuff?" And it's like, yes, but like it wouldn't kill you to think about 6 months ago that you should have maybe been putting some of this in place. So I think it's always better to think in advance.
And I really do think that there are a number of items about being a public company that are just different than being a private company. And you mentioned ESG. You mentioned a couple other topics. I also am not a huge fan of the proverbial tail wagging the dog. I think it's really important to focus on, operational excellence and financial performance, and also thinking long term about, the strategic direction of a company. I mean, one of the things that you do think about as a company gets to this point, often, by doing one or two things really well. And as being a public company, they'll have to think longer term. They'll have to think about competition in different manners, and really beginning to give that some thought. If one of the most interesting things I've ever heard is with a company going public was with somebody at the NYSE making the comment that the growth in terms of job creation and also in terms of revenue growth at companies, is much greater after a company is public than it is before. And there's a lot of work that goes into that. And so it's not something to be taken, lightly, that there is a lot of preparation, and the end goal is not just to get a company public, but to have it be a successful public company in the long run. And that takes a lot of work. And that's not to say, not having an eye to some of these governance and legal requirements that come up as well, but having a healthy balance between the two.
Yeah, I love that. So maybe we'll do one quick last one, which is, there's also a lot going obviously on in public markets. We've seen some big M&A activity, et cetera. What advice do you have for existing public companies that you'd want to share with us quickly?
Yeah, the environment for existing public companies, as I mentioned earlier, has been challenging as well. And in particular, especially for some of the companies that went public kind of in the 2021, early 2022 periods. And, maybe some of that had to do with a number of those companies being a little bit earlier in the maturation process than otherwise. But the U.S. capital markets for public companies and financing transactions for those companies is improving. I think it's a little bit behind where new issuances are, to be honest. And we've seen some really exotic, structures and transactions. That's not to say that there's not, that a number of these aren't done all the time, like pipe transactions and at the market transactions, but we're seeing some really creative financings. I'm hoping that there's a swing back to kind of more normal, kind of typical follow-on offerings.
I feel like that's a glass of wine subject. Like, what's the weirdest structure you've ever seen?
No, absolutely. And I do take a long-term view with this. That there's not an exact science for valuing a company. Obviously, at least in the technology sector, you've seen a lot of price erosion for many companies over a period of time, but a number of those companies are very well positioned to have, wonderful futures and really strong growth. A lot of them have tended to their knitting, have reduced expenses, have really focused on profitability, have taken a really hard eye at their businesses, and are primed, hopefully, as we come out of, the last 18 to 24 months in terms of a difficult economic environment for many of these companies. So I'm cautiously optimistic. I'm always very cautious because a number of things can go bump in the night. But hopefully, we'll be looking forward to a 2024 that looks very different than where we were at the beginning of 2023.
So that's all the time that we have for today. Thank you so much, Mark, for those great insights. If you're interested, you can read more about these topics on the Wilson Sonsini website at wsgr.com. Thank you so much for listening, and please join us next week for another edition of Inside Today's Boardrooms.